Trade tensions escalate. Between the US, Canada, and the EUAs, President Trump rolls back tariffs on most products from Mexico and Canada. Canada has stated that its retaliatory tariffs will remain in place until a permanent resolution is reached. In response to Trump's significant tariffs, Canada quickly announced a massive $760 billion plan to retaliate, while the European Union introduced a $40 billion tariff package of its own. This situation is not just about a few additional taxes on imported goods. It is shaping up to be a full-scale economic conflict that could impact global markets in ways not seen in years. The European Union reacted almost immediately after the US move, as American steel and aluminum producers gained a competitive edge from the tariffs. European leaders, unwilling to let their industries suffer, imposed counter-tariffs on a range of US products valued at approximately $26 billion, roughly $28 billion. The affected products include industrial machinery, car parts, and agricultural goods such as fruits, vegetables, and wine. These tariffs were not randomly placed. They specifically targeted American exports in key industries. Canada, another country heavily impacted by US tariffs, also responded with strong countermeasures. The Canadian government imposed retaliatory duties on more than 2,800 US products, including Levi's jeans, whiskey, and Boeing aircraft. This was not merely a symbolic response. Canadian officials made it clear they intended to make the trade war as difficult as possible for US industries. With US exports facing rising costs and trade barriers, businesses across multiple sectors, particularly agriculture and manufacturing, are experiencing increasing uncertainty. Many American companies, especially in agriculture, are feeling the pressure. Farmers who rely on international markets to sell their crops are finding their products more expensive and less competitive abroad. The whiskey industry is also struggling, as Kentucky bourbon producers face new European tariffs on American-made spirits. It is not just small businesses being affected, major US brands are also feeling the impact. Harley-Davidson, for example, has seen its costs rise due to European tariffs, which may force the company to raise prices or move some production. Overseas. Concerns over US-Canada-EU trade. Relations. One of the biggest concerns is how these escalating trade tensions will affect overall economic relations between the US, Canada, and the EU. For years, these economies have benefited from relatively free trade. Now, with retaliatory tariffs in place, the entire system is at risk of unraveling. Since the Comprehensive Economic and Trade Agreement, CETA, between Canada and the EU took effect, trade between the two regions has increased by 7%. As tensions. With the US rise, Canadian businesses are beginning to shift their focus away from American markets, looking instead toward Europe and Asia for new opportunities. This shift is significant as Canada has historically depended heavily on trade with the US. However, businesses are now taking steps to reduce that reliance. More Canadian companies are exploring European markets, benefiting from trade agreements that may offer better terms than those with the US. It is not just businesses making these changes. Canadian consumers are also adjusting their shopping habits. There has been a noticeable increase in demand for Canadian and European brands as people seek alternatives to American products. Potential consequences of the trade war. The key question is whether these trade battles will spiral out of control. The US imposed tariffs intending to protect American industries, but the retaliation from Canada and the EU could cause more harm than good. These countries are not simply accepting the tariffs. They are actively seeking ways to reduce their dependence on the US economy. If this trend continues, American businesses could face significant challenges, including reduced access to key international markets and rising costs. The effects are already visible in financial markets. Investors dislike uncertainty, and every new round of tariffs increases instability. Following Trump's tariff announcement, the S&P 500 dropped by 0.8% within hours, and companies directly impacted by the tariffs saw even greater declines. Steel and aluminum prices have surged, raising costs for American manufacturers that rely on these materials. The automotive industry, including companies like Ford, General Motors, and Tesla, is also struggling with higher material costs, forcing them to reevaluate their supply chains. Future outlook. Will the trade war intensify? The critical question now is whether the US will back down under pressure from its trading partners or escalate the conflict further. If countries like Canada and the EU continue to move away from American trade, it could reshape the global economy in the long run. One of Canada's strongest retaliatory measures was its decision to impose a surcharge on electricity exports to the US. This is not a minor response. It directly impacts a crucial resource that millions of Americans rely on. Nearly 1.5 million Households in states like New York, Michigan, and Minnesota are expected to experience rising electricity costs due to these new tariffs. For years, Ontario and Quebec have been major electricity suppliers to the US, particularly through hydroelectric power. Now, with Canada imposing a 25% surcharge on electricity exports, the economic strain between the two countries is set to increase even further. Just as President Trump rolls back tariffs on most products from Mexico and Canada, Canada has stated that retaliatory tariffs will remain in place until the change becomes permanent. Canada wasted no time in announcing a massive $760 billion plan to counter Trump's hefty tariffs, while the European Union introduced its own $40 billion tariff package. This situation is not just a few taxes on imported goods, it is shaping up to be a full-scale economic battle that could impact global markets in ways not seen in years. The European Union acted almost immediately after the US move. With American steel and aluminum producers gaining a competitive edge due to tariffs, European leaders decided not to stand by and let their industries take the hit. They imposed their own counter-tariffs on a range of US products worth about 26 billion euros, roughly 28 billion. What kinds of products are affected? Everything from industrial machinery and car parts to agricultural goods like fruits, vegetables, and wine. This was not just about targeting random industries. It was a strategic move aimed at American exports where it would hurt the most. But the EU was not alone. Canada, another country deeply impacted by US tariffs, responded forcefully with its own countermeasures. The Canadian government imposed retaliatory duties on more than 2,800 US products, covering everything from Levi's jeans and whiskey to Boeing aircraft. This was not merely a symbolic move. Canadian officials made it clear that they were prepared to make the trade conflict as difficult as possible for American industries. With US exports facing rising costs and new barriers, businesses across multiple sectors, particularly agriculture and manufacturing, were suddenly facing a much more uncertain future. Many American farmers rely on international markets to sell their crops, and these tariffs are making their products more expensive and less competitive for foreign buyers. The whiskey industry is also under pressure, with Kentucky's bourbon producers now struggling as the EU imposes additional tariffs on American-made spirits. And it's not just small businesses. Some of the biggest brands in the US are starting to feel the effects of these trade disputes. Harley-Davidson, for example, has already seen costs rise due to European tariffs, which could force the company to either raise prices or shift some production overseas. One of the biggest concerns is what this means for overall trade between the US, Canada, and the EU. For years, these economies have worked closely together under relatively free trade agreements. Now, with each country retaliating against new tariffs, the entire system is at risk of unraveling. Since the Comprehensive Economic and Trade Agreement, CETA, between Canada and the EU took effect, trade between the two regions has grown by 7%. Canadian businesses have begun shifting their focus away from the US, looking instead toward Europe and Asia for new opportunities. This shift is significant. Canada has long been heavily dependent on US trade, but with rising tensions, businesses are taking steps to reduce that reliance. More Canadian companies are exploring European markets, taking advantage of trade agreements that offer them better terms than those available with the US. And it's not just businesses making changes. Canadian consumers are also starting to shift their shopping habits. There has been a noticeable increase in demand for alternatives to American products, with people opting for Canadian or European brands instead. As tensions escalate, the big question remains: will these trade disputes spiral out of control? The US decision to impose tariffs was intended to protect American industries, but in reality it has triggered a wave of retaliation that could cause greater economic harm. Countries like Canada and the EU are not merely reacting, they are actively working to minimize their dependence on the US economy. If this trend continues, American businesses could find themselves locked out of key markets, facing fewer buyers for their goods and higher costs across the board. The consequences are already being reflected in stock markets. Investors dislike uncertainty, and every new round of tariffs adds more instability. Following Trump's initial tariff announcement, countries are actively working to reduce their dependence on the US economy, which could mark the beginning of a significant shift in global trade. If more nations follow Canada's lead and decrease their reliance on US imports, the United States may experience a long-term decline in economic influence. The trade conflict initially centered around steel and aluminum, but its effects have now extended to various industries. The key question is whether the US government will maintain its stance or attempt to ease tensions. If the situation escalates further, both countries will face mounting pressure to find a resolution before the economic impact becomes too severe. However, with both sides firmly holding their positions, a swift resolution seems unlikely. For now, attention remains on the next moves from Washington and Ottawa. Will the US impose additional tariffs? Will Canada continue reducing trade ties with American businesses? Most importantly, how will this growing economic dispute affect ordinary people on both sides of the border? While the US-Canada trade dispute dominates headlines, another key North American player, Mexico, is carefully considering its response. As one of the United States' largest trade partners, Mexico has taken a measured approach, favoring negotiation over immediate retaliation. However, this does not mean Mexico lacks the ability to influence the situation. If tensions continue to rise, Mexico could take significant economic actions, particularly in the energy and automotive sectors. For years, Mexico has been a vital supplier of crude oil to the US, accounting for around 8% to 10% of total American oil imports. More than 1 million barrels of oil per day flow between the two countries, supplying refineries in Texas, California, and other states. If Mexico were to reduce or halt this supply, fuel prices in the US could rise sharply, adding to existing inflationary pressures. This disruption could affect multiple industries, including transportation and manufacturing. The automotive industry is also deeply interconnected with Mexico's manufacturing sector. Major American automakers such as Ford, General Motors, and Chrysler rely on Mexican factories for parts and vehicle assembly. Many vehicles sold in the US are built using components that cross the border multiple times before reaching dealerships. If Mexico were to impose tariffs or introduce trade barriers, American automakers would face immediate challenges, leading to higher production costs, increased vehicle prices, and potential job losses in the US auto sector. So far, Mexico has exercised caution. President Andrés Manuel López Obrador has prioritized diplomacy over retaliation, emphasizing negotiation as the preferred approach. However, the Mexican government has made it clear that if the US continues its current trade policies, it will be forced to respond. One potential target for retaliation is US agricultural exports, including corn, soybeans, and beef, key products for American farmers. If Mexico imposes tariffs or trade restrictions on these goods, it could put further strain on an already struggling industry, especially amid the ongoing US-Canada trade dispute. Beyond tariffs, Mexico could also take steps to limit American economic influence. One proposal being considered is restricting certain US companies from operating within Mexico, which would impact American corporations that have long benefited from lower labor costs and favorable tax conditions. Given Mexico's role as a major manufacturing hub for US businesses, any disruptions in trade relations could have significant consequences. As tensions rise, leaders from both nations are under pressure to find a resolution. Mexico's president-elect, Claudia Sheinbaum, is taking a proactive approach, seeking direct talks with US officials before any retaliatory measures are implemented. She is expected to discuss potential solutions in an effort to prevent further escalation. While she has expressed a desire to avoid a trade war, she has also emphasized that Mexico will not allow its economy to suffer due to American tariffs. If negotiations fail, Mexico has set a deadline for March 9th, at which point it will announce countermeasures. This deadline adds another layer of uncertainty to an already tense trade situation in North America. Should Mexico impose tariffs or take other actions, the US could find itself in an even deeper economic conflict with its neighboring countries. Society, North American supply chain is highly interconnected, and a full-scale trade dispute could cause widespread disruptions. Meanwhile, Canada continues to take steps to reduce its reliance on the US market. Canadian leaders view this trade dispute not as a short-term disagreement but as a turning point, signaling the need for long-term economic diversification.